Hola a todos, ¿qué tal estáis? Bien.
Hello, everybody. How are you? And welcome to the second day of BIOS 3 Best Investment Opportunity Summit, the conference in which we are going to be hearing about great investment opportunities that we're bringing to you by the hand of the managers, the professionals that are managing this portfolio and look for profitability in complicated markets. And we're doing this live. This is 4 p.m. with the NASDAQ with this 3% increase in the opening and with these markets being close to their maximum positions at this time. But in these complicated markets, we want to hear what the managers have to say with regards to how are the possibilities right now of obtaining returns in these complicated times. Thank you very much to those of you who follow the session yesterday and those of you now. We're really happy to be having this interactive summit with you. Thanks also to the partners that are making possible this BIOS, this third summit. And for example, Aberdeen Standard Investment, Carvignac, Fidelity, Schroders, BNY Mellon, Investment Management, Capital Group, Natixis, Nordea, and Vontobel, and of course to another of our partners, EBN Banco. EBN is a platform that you can get access to, for example, to clean fund classes, so that you will get to know directly the funds of those funds that you are contracting, and the three professional associations of investors that are supporting us and that is sponsoring us gives us their strength, and they give us feedback to improve the certification of the investor managers, those professionals in investment, and all the information related with BIOS. You'll have it at Grupo BIOS and Finect. You can get access through Finect.com. You will be able to get the agenda. We are uploading the presentations, and as they are done by the speakers, you have links to the test in order to see the certification of the managers. You get access to the Q&A part, and you will be able to have access to the information of all the funds. You have all the information of all the funds, and you give you the option of contracting them directly from our webpage, because sometimes they say, oh, this is so good, but how can I do the contracting? Well, you can click in there and you will see how to contract these investments funds, and you can do so through EBN Banco, which is one of our sponsors, of our partners, and they give you the possibility of getting access to these clean types of investment funds. So we have there all the information about the funds. We have the link to the question area within the app. You do not need to download anything else, and you can go in there in order to formulate questions and also to answer our surveys. You have there our URL. You can get into finect.com/bios, or you can do so with this QR code that you will have it in there that you can capture with your camera, and the QR of each one of the funds will be on the screen while we hear the presentation of each one of their speakers. As I was saying before, we're going to do a small test. It is very important for you to get there. You can capture with your camera of your mobile that QR code, and that will give you access to this URL in which we're going to launch now a first survey, so that we see what is your feeling about this BIOS version. So finect.com/BIOS, I hope that it is already open and you can get into our question. What of the following topics do you think is more attractive for portfolios? And we're going to give you 5 options. Aging of the population, better use of the water, cybersecurity, energy transition, or ESG, specializing in improving social rights. So the time to vote starts now. There you got these 5 options. I hope that you find them interesting as well. Maybe they're part already of your portfolio, and if you don't have any of them, you might consider introducing this thematic in your portfolios, and we're going to see. Now it seems like there is still a little bit of uncertainty. We do not know what's going to happen. We're lacking a lot of information, and this is what we would like to know. We're asking questions, and I'm already getting the results. Let me tell you about them immediately. Let's see what you think. Oops, there is a high distribution of the votes. cybersecurity is ahead, but only by very little points. But there are very interesting ideas that you can apply to your portfolios. Thank you very much for your participation. As you know, through this web app, you have the possibility of formulating questions. You formulate them while you're listening to the presentations, and at the end of them, I will be able to read them. So without further ado, we're going to start seeing the first idea of this BIOS 3.
Vamos ya con esa.
Okay, let's go. At Fidelity, we've been creating value for more than 50 years for our customers. Their trust is translated in more than 410 billion euros managed worldwide. We generate and recreate opportunities thanks to our own proprietary analysis and research. Independence. Innovative nature. Customer-centric. We work day after day to continue on building trust and generating value. So we're starting our second day of the BIOS 3 from London, and we do so with Toby Gibb. Toby will tell us about the opportunities that they're seeing within the water theme in their Fidelity Fund Sustainable Water Waste Fund, because it is in water where he likes to be. He loves surfing and sailing, as well as he likes practicing many other sports. So welcome to BIOS, Toby. We can hear you now, and you have the floor.
Thank you very much. I hope everyone can hear me. My name is Toby Gibb. As it says, hopefully on the slide in front of you, I head up the investment directing function at Fidelity. And today I wanted to talk to you about water and waste management, which is a long-term structural growth theme, which hopefully will provide, I think, a good distraction from the trials and tribulations that we're seeing in the technology markets today and the world of Bitcoin as we speak, and also probably provide useful diversification relative to the other themes that we were talking about, that the host was talking about a minute ago, particularly areas like cybersecurity, given the more defensive nature potentially of water and waste as a theme. So what I wanted to do really was focus on the theme itself, talk a bit about the long-term structural growth story, and then dive into water as an investment opportunity, and then waste as an investment opportunity. And then I think we have some time for questions at the end. So if I can work the technology, I'm hopefully going to move on a couple of slides. Yeah, so let's start just by talking broadly about water and waste and the long-term structural growth story that exists here. So water and waste is really a very simple long-term story that's been with us for thousands of years and really will be with us for as long as humans remain on the planet. And as we'll see over the course of this presentation, the two, water and waste, are very closely linked. So water and waste is essentially a story of civilizations. So when humans stopped being hunter-gatherers, they settled near rivers, near the sea, near lakes, so that they had water for agriculture. Water was an essential part of this building of civilizations. As the community grows, their requirements for water grow. Water is not just needed for agriculture, but also, initially to provide energy through mills, and then as production increases, the need for the greater need for clean water increases. And as then the community gets richer, they tend to produce more waste. That waste increasingly becomes more complex to deal with and requires greater technology to be able to treat it. And that's really the first of the 5 key drivers impacting the water and waste value chain, that urbanization and growth of civilizations. The second is about consumption. So as communities get richer, they also consume more, as we know. And consumption is very water intensive. And when I talk about water intensity, I'm not just talking about the 150 litres or so a day that we use for drinking, for cooking, for bathing, showering, etc. No, it's much more than that. It's much more than just that 150 litres. We actually use more like 15,000 litres of water a day, because a lot of the things that we consume are very water intensive. So it takes around 8,000 litres of water to produce a pair of jeans, 15,000 litres of water to produce just 1 kilogram of meat. And things like electricity are extremely water intensive. So, we're boiling water essentially to drive turbines. Water is being used in nuclear power. So, really the point here is that without water, there is no economy. And on the other side of this consumption story is waste. So everything, or pretty much everything that we consume becomes waste. So within a couple of years of consuming, 95% of that consumption has become waste, and that needs to be dealt with, as I'll talk about later on. All of this, the growing of civilizations and urbanizations, and the increase in consumption and the waste that produces, puts pressure on the infrastructure, and that's very much the third driver behind the water and waste value chain. So infrastructure globally is aging. So if you look at a city like London, the water and sewage infrastructure was built 150 years ago, and it needs to be replaced. That creates investment opportunities. We also need to improve the infrastructure for waste. Waste, still 60% or so of waste is still just taken into landfill, and that can't continue. That has to change. And as it does change, it becomes more expensive to do that. If you want to recycle waste, if you want to convert waste into energy, that's a lot more complex, and a lot more value is added, essentially, to treat it, to recycle it, and to convert it to energy. So that's the third driver here, is the pressure on infrastructure. And then the fourth is regulation. Both in terms of how the providers of water and the treaters of waste are regulated, but also regulation in terms of the water that's supplied and how waste is treated. So often water utilities and waste management companies operate in a monopoly, given the very local nature of these businesses. Regulation is there to ensure that people aren't overcharged. It's also there to make sure that investment is encouraged, and so companies are allowed to make a good return over that of inflation, and that's a very stable return, and one that's quite uncorrelated with stock markets more broadly, because decent returns are allowed to permit and encourage investment. But there's also regulation in terms of how water and waste is treated and dealt with, and that creates opportunities from a technological advancement perspective. And a good example of that is new regulation that's come into play to treat ballast water. So when a ship travels from Australia to Singapore, and when it discharges its cargo, it fills up with ballast water, and then it discharges that when it gets to the port at the other end. It's very important that water is treated, otherwise you can do a huge amount of damage to the biodiversity in the port that you're landing in. So that's very important regulation that has significant implications and has meant significant new revenue streams for a number of companies that operate in this space. And then the final driver here is resource scarcity. So we have a limited amount of fresh water. Clearly, we have a huge amount. 71% of the Earth's surface is covered in water, but we have a finite amount of fresh water. This needs to be treated. It needs to be transported, and likewise, we cannot dump waste forever. It needs to be dealt with in a proper way. It needs to be recycled, and these again create opportunities for growth. So these are very powerful stories and very powerful drivers that will be with us for many, many years to come. So I'm going to start by talking about water on what I hope is slide 4 that you can see in front of you. And this is really the volume story. So on the left-hand side, we can see the amount of of water consumed versus population growth. So we can see quite clearly that water consumption is growing much faster than the population is growing. So the water intensity of our consumption as human beings is increasing. And as we can see on the right-hand side, or hopefully you can see it's quite small, but there will be a water gap. So demand for water is outstripping supply, which means that we need to either become more efficient in terms of the water that we use, or we need to increase supply, whether that's through new technology, through desalination, etc., or through building reservoirs, and all of those create an opportunity. So as I said, there's a strong volume growth story in the water market, and then the next point is price. So this is a slightly complicated chart, but when I explain it, it should make sense. So essentially, what we've looked at is on the y-axis GDP per capita, so the wealth of a country, and on the x-axis the price of water, and then the size of the bubbles here are the size of the population in each of these countries, and the orange bubbles are BRICS, and the blue bubbles are other countries, mostly the developed markets. So the clear picture here is that as populations grow richer, the price of water goes higher. So that shows that there's a huge opportunity in countries like India and China with massive populations for the price of water to normalize. And I think what's really important to note is demand for water is very inelastic. One, because it's essential. We need water to live. Industry needs it to produce. Agriculture needs it to operate. But also, not many people know how much they pay for water, which I think adds to the inelasticity. So on average, it's about $3.50 per 1,000 liters of water. But I doubt there's many people on this conference who knew that, and on average we pay around $60 a month for water, which means it could be quite a lot higher. And probably not that many people would notice. So if the cost of water per month went up, people would probably not consume less. So there's a strong inelasticity from a demand perspective. Let me just try and move on to the next slide. So demand for water is increasing, and the capacity to pay for it as developing markets develop is also increasing. And what's really interesting from an investment perspective is there are so many different ways to play this theme, and it's a very global theme. So many companies will benefit from this trend, and it's not just the utilities, the water utilities, which are the obvious ones. Actually, they make up quite a small part of the overall water universe. We can invest in companies across this whole value chain, which you see in front of you on slide 6. From really the moment at which we pump water from its source until the moment that we release that water and to consumption, to industry, to agriculture. So this includes areas like desalination, pump manufacturers of pipes and valves, filtration systems, treatment companies, testing and laboratories, and also construction and designers of water treatment centres and reservoirs. And it's not just about the municipal use of water. Industrials and agriculture are also huge consumers. Actually, agriculture is probably 60% of water consumption. Very important users of water. And what's interesting from an investment perspective is that these companies tend to be very uncorrelated. So you can build a very strong portfolio of uncorrelated revenue sources from such companies. And we're able to select essentially from across this entire value chain. Now I just wanted to move on and talk about waste, which is something which is quite unique to the strategy that we manage. So, we don't just invest in the water value chain, but also we invest in waste. Sorry, I'm British, so I need to have a gulp of tea at this point. The waste market, which we can see, and a similar picture to the one that we saw for water. So as civilization grows and as that civilization moves more and more to cities and consumes more, becomes richer, the amount of waste that they produce increases. And that's what we can see on the chart on the left-hand side. And importantly, and importantly from an investment and a technological perspective, as economies advance and evolve, the nature of that waste becomes more complex and harder to treat, and more value is added by the companies that do treat it. So 100 years ago, it was just organic matter, wood, metal, glass, that was produced as waste, which is not particularly polluting. Now, the waste that is produced is much more complex. It's much harder to treat. We want to not just dump it in landfill. We want to recycle it and find use for it. But also that waste is much more concentrated now than it was in and around cities, given the speed at which we have urbanized as a race. And then to look at a similar picture to the one that we saw for water. So again, the richness of a country on the y-axis, and then we've just switched for the price of or the cost of waste treatment on the x-axis. Similar bubble size is the size of the population. And we can see that clearly a very clear picture that as a country becomes richer, the cost of waste becomes higher. So on average, people produce around 450 kilograms of waste per year. That equates to about 1.2 or thereabouts kilograms of waste per day. We can see pretty much bang in the middle of this picture is Spain. So it's almost exactly at the average of 1.2 kilograms of waste per day. And we can see that China, so the large orange bubble there, produces 4 or 5 times less waste than Spain. So there's huge potential there for that to grow. Huge potential for the top lines of these companies to grow quite meaningfully. And like water, the demand picture here is quite inelastic. So, very few people know what the cost is of taking away waste. Typically, it's about $20 per month. So about a third the cost of that we pay for our water bills. And generally, that $20 is used to transport the waste away and to put it into landfill. And so as populations grow, the demand will increase, but as our requirements from a waste perspective become more complex, i.e. we're not just happy with dumping it in landfill, we want to see it recycled, we want to see it converted into energy, then we can easily see the price of waste doubling to $40, which is a relatively small impact on people on people's overall balance sheets, but it's a significant impact of doubling in the top line of the companies involved in treatment of waste. And then if we move hopefully to the next slide. So this is just looking at one area from a waste perspective, but a very important and topical one, and which makes the point about the complexity of waste. So this is looking at plastics. So we have seen an exponential growth in plastic since the start of the petrochemicals industry back in the 1950s. This will continue, as we know, even as we increase recycling and we try to reduce demand for plastics. The picture that we see in front of us here has shown what has happened since the 1950s in terms of the production and the use of plastic. So around 8.5 billion tons of plastic have been produced since the 1950s. Some of that is still in use. So 2.5 billion tons is still in use. That's in our TVs, in our computers, in our cars, etc., etc. And some has been recycled, some has been burnt at a relatively small amount, but around half of it remains in the environment. And I think what's interesting to note here is that most thematic funds, and certainly a number of the thematic funds that we manage are focused on the blue arrow here. So it's about the production, it's about consumption. What we're focusing on in the waste element of our water and waste strategy is what is done with the outcome of a lot of that consumption. How do we deal with the waste? How do we treat it? How do we recycle it? How do we try to create value to it? So, that makes this, I think, a very great complement to other strategies.
Toby, tienes que ir terminando.
Toby, you need to finish. You only have 1 or 2 minutes left because we have to move into the Q&A session. If you could summarize in a minute what you have left.
Sure. So, on slide 10, I think we can cover this very quickly. So, as with water, there are many, many ways to invest in the waste value chain. That starts at the integrated waste companies and goes all the way through to the companies that are involved in much more complex waste management services or recycling or conversion of waste into energy. It's an area, both waste and water, which are growing very rapidly. The universe of stocks is growing, their revenues are growing, and the investment opportunity is therefore growing. And it's also a theme that has outperformed quite materially over the long term. When we look at data, it's significantly outperformed the broader market. But it's not all about performance. It's all about looking at impact and looking at what we're achieving by investing in these companies, and that's a really important element of our process. Is understanding the impact of this strategy. So, being aligned with 13 of the 17 Sustainable Development Goals, but also being able to measure for each dollar that's invested in the strategy how much water is produced, how much waste is treated, how much CO2 is avoided, how much clean power is generated, and also how much CO2 is emitted. So a long-term structural growth theme that we believe will provide strong outperformance over time, but also one with measurable impact that we can demonstrate to our clients. So I will pause there and open up to questions. Hopefully that was not much more than an additional minute.
Muchas gracias, Toby.
Thank you so much, Toby. So we're going to start with a question that was formulated by a financial advisor. In this case, the question is going to be formulated by Gabriel Lopez, by Invertif EAF. You can also find him in our platform of advisors by Finect, and this is his question. Well, thank you very much to Fidelity. They're doing a wonderful job as active managers of funds that are always looking for the alpha, and I believe that with this new fund, that although his track record is somewhat limited, they're going to be able to obtain potentially high returns, taking into consideration the integration of Bertrand Lacour with a high experience in the sector, more than 20 years. So my question is the following one. What is the growth in terms of profits that you are expecting for your water and waste portfolio in the next 3 to 5 years, if you are if you think that it is cheap or expensive, or in terms of valuation, since there is no benchmark, where you think that you can place it? Thank you.
Yeah, no, thank you very much. Thank you very much for the question. What's interesting about water and waste as a theme is it is quite a visible return. So we do a lot of the companies or a number of the companies in the sector have regulated returns, and these tend to be in the sort of the mid-high single digits. So that's quite a stable and dependable return that we can see. At the aggregate portfolio level, I would say that we typically see earnings growth on an annualized basis of around 10% or thereabouts, and a reasonable dividend yield, sort of 2% plus, and the potential, particularly after a year in 2020 when these sort of companies tended to underperform the sexier technology type companies. There is some potential for some some re-rating as well. So I would say you're on that basis 10% plus 2-3% plus another sort of 3-4%. So probably conservative 15% per annum returns is I think quite achievable.
Seguiremos ese comportamiento.
Okay, we will follow the behavior. You know that in our in our website you can see the profitability. Toby, one more question: how will impact the creation of a new technology that it is capable of cleaning seawater? Will it be the end of the water scarcity, of the running water scarcity that we're facing in some places of the world?
Yeah, I think it's obviously desalination is a technology that has been around for some time, and in countries like Australia, it's a very important part of the water supply, given the sort of the dryness of the country and the inability to be able to import. And I think as that technology improves, I think it will have a positive impact on the scarcity issue that we have. It doesn't solve all problems. I think we are going to have to continue to become more efficient. But I do think for certain countries and particularly for things like agriculture, it's a very, very important technology, and again a very, very interesting investment opportunity.
No sé si la esperarías, pero hay.
I don't know if you're expecting this, but there is a question related to the water futures that started trading earlier on this summer in the United States. The question is, how would this affect your portfolio if this water rights model becomes more popular around the world?
Which model, sorry?
El modelo.
The investment model, which is based on water rights or water options that have been trading in the United States markets this summer. How would this have an impact?
I guess what we tend to see with derivatives markets is it can lead to an increase in volatility. We've certainly seen that and particularly if it becomes an area where retail investors become interested. So potentially a slight increase in market volatility, which again can create some opportunities. So it's something to watch out for. But I think the focus has got to be on the long-term fundamentals of the theme, and more specifically the long-term fundamentals of the companies that we can invest in, which as I said are very, very diversified from the sort of the producers of water and the water utilities themselves through to the waste management companies, but so many different types of companies in between with so many different growth drivers.
Y para terminar, Toby, yo no sé si
the new millennials and aiming to reduce consumption, aiming to reduce waste and excessive consumption. Can this have a positive long-term impact on your fund? Is it one of the underlying themes?
I think, one of the really interesting areas and one of the key areas of focus for us at the moment is this change from waste being a structural growth story, which it has been for many years as as the population grows and we become increasingly urbanized and waste increases, which is clearly has been a structural growth story, but also is not sustainable. And I think the next frontier from a waste perspective has got to be how we think about recycling and what we do with that waste and treating it in much more sustainable ways than simply taking it to landfill. So looking at new technologies enzymes that can break down plastics, looking at ways to even sort of clean the oceans, but the sort of the treatment and the recycling of that waste is becoming a more and more important theme and a more important part of the the investment opportunity in the fund. And what's interesting is these are new technologies, these are new companies, these are new IPOs that are coming up every month or every few months, which is incredibly exciting, and it's giving us an increasing investment universe to look at, and more growth opportunities going forward. So I would expect the strategy over the sort of short to medium term to move away from some of these pure waste treatment companies, the likes of Republic Services and what have you, which tend to be a little bit more old-fashioned and a little bit more polluting, in fact, to companies that are much more focused on recycling. And I think that's good for the fund. I think that's also good for the planet.
Pues muchísimas.
Thank you very much, Toby, for joining us this afternoon. Thank you very much for opening this session. Thank you. It was a pleasure to have you here.
My pleasure. Thank you very much for your time.
Muchas gracias. Sacad, por favor, los...
Please take your mobile phones, finect.com/bios, because we're going to vote. First of all, what did you think about this investment idea in wastewater management? What did you think about it? You have the address there, the QR. Time to vote starts now. There you have it. This is the time for voting. We always ask first. We ask for this investment theme or investment idea. Did you like it? Not? And the time to vote starts now. And let's now ask you, what did you think about his presentation? How did he answer your questions? Time to vote starts now. So this is very interesting. What is your view on your presentation, on his presentation, the way he presented it? This is interesting because we get to see what are the most interesting themes for upcoming decisions of the Best Investment Opportunities Summit. And this is the end of the first one, but now we have a very interesting theme ahead of us. Let's launch the second idea of this second bias session. We're going to take a shuttle to Zurich, where we're going to connect with Nuria Jorba, with a track record of 20 years of experience with the aim to look for EM bonds in order to find and secure yield in these very stressed markets, an option to relax as good as yoga that she likes practicing. And this is what she can do when her youngest daughter allows it. Time for you. Thank you. At last, we have a speech in Spanish. Thank you very much indeed. Hello. Thank you very much indeed. And thank you all. Good afternoon, everyone. And I'd like to give a warm welcome to all participants on this BIOS edition. I came here to present an investment proposal that's very important this year, the EM Corporate Debt Fund from Vontobel. Let's now move on to the next slide, please. Why is it so interesting to invest among EM corporate debt? EM bonds, if you would please move up one slide. I think there's a bit of a delay in the agenda, says the speaker. But basically, the first rationale that we have found is its size. It's a quite sizable market. EM corporates have been growing in the last 15 years substantially. Most importantly, since 2009, in which we had seen, after the main Lehman Brothers this crisis, when banks discontinued funding to different corporate companies, had to look for other capital markets sources and alternatives in order to secure financing. As you can see here, since 2008, the size of EM corporate debt moved from $500 billion to 2.5 in 2020, so twice as much in 5 years. Does this include pure corporate debt and also all different government debt? So the fixed income market in this includes twice as much the size of sovereign debt. Against everybody's thought, thinking that government bonds tend to be higher, corporate debt is a sizable market compared to government debt. And the most important factor here is to stress out that despite the size, specialized asset managers in EM corporates, so active managers, only represent about 3% of the market. The market creates a lot of efficiencies. So specialized active investors are those leveraging on the best opportunities and that can secure interesting yields. If you would please move up one slide. Apart from the size, we offer great diversification. So we are talking about companies that are based in 60 countries around the world, and most importantly, Asia and including China, obviously, are a sizable part of the market. But also these corporates are in Latin America, in Europe, in Africa, and in the Middle East, and we have seen exponential growth in this region. Apart from the diversification in the different geographies, there is also diversification in terms of industries where these come from. So the industries covering or following this issuers, different credit ratings. We can invest in AA or triple C. So there's a wide variety of credit ratings, and asset managers can actually choose where to invest. On the next slide, you will see that there is also that in reality, the yield, the long-term yield is also very appealing. Commonly understood, people think that this is a highly volatile asset, but in the long run, returns have traditionally been, and if you compare the historical evolution, and if you compare it to the benchmark, JP Morgan's CEMBI, in the last 8 years, we have an annualized return of 7.4%. And obviously, we don't receive these returns every single year. There's also spikes of volatility, but it is not so high. And in reality, as you can see on the chart, there's never been 2 consecutive years of negative returns. So when there is a negative year, this means that the valuations are so attractive that investors enter, and the year after is much more attractive. So therefore, it is important to remember that corporate debt in emerging markets is less volatile than what you think, and it gives you positive returns if the investment is maintained in the long run. As you could see on the next slide, why do we think it is a good moment to invest at the moment in corporate debt? The spreads are higher and the duration is shorter. And in the situation in the current market where the different government rates are, very low with an upgrowing trend, positive returns will have to necessarily be secured because of the narrowing of spreads. And as you can see here, the green balls represent several assets in EM debt. To the left, top left part of the screen, you've got EM corporate debt. In fact, high yield bonds are the most interesting ones to us, because if you compare it to similar assets of a similar credit rating, spreads are higher, wider. For instance, high-yield U.S. bonds, when you compare it to EM, credit ratings are higher. So on average, is BB minus compared to B plus for the United States. The duration is shorter, so 1 year duration, 1 year shorter. And the spreads are much more appealing. So that's why we strongly believe in our team that is a no-brainer. It is an investment idea that has no paragon. We can also compare to speculative or high-yield European bonds with a similar duration, but in reality, the spreads are also supported with higher liquidity. We have seen that European debt, when liquidity is needed, is not there. So therefore, we strongly believe that corporate debt, EM corporate debt, is offering this year or the next few months. This is what we need in order to secure positive returns. And on the next slide on the screen, you can clearly see that at the moment, 80% of the returns among EM corps comes from the reduction or spread compression. So that was 90% last year. But given the big returns we have by mid-year, it went down to 80%. And it's true that we believe this is here to stay a few years until more normalized levels. And if we now move on to the next slide on the screen, why do we think we need to invest in Vontobel? What do we offer at Vontobel? We believe that our fund gives us a unique approach, combining the optimization of spreads with diversification. Optimization is what we call the value trade. We look for those bonds within the benchmark that offer more appealing spreads in exchange for the same credit quality. So we may have the same corporate, but issuing bonds in different currencies. If a currency is more attractive than others, we will then invest in this specific bond. Another example are companies within the same industry and with a similar credit rating, but in different countries and regions. These can be penalized with wider spreads in a certain company. So we choose this company because we believe that with time, these spreads will be reduced. And typically, this type of the portfolio accounts for 70 to 80% of the portfolio. And it offers 250 to 500 bips of spread above the benchmark. And it is true that the credit quality is a little bit lower. So we're talking about the fact that we have a BB rating, whereas the benchmark is BBB minus. And when we conclude optimization, these bonds are uncorrelated. Now, diversification, the event-driven. These are bonds that, for no obvious reason in the market, an idiosyncratic reason, the bond is plummeting. And given the current market situation in which the movements or the declining prices is magnified. Perhaps this is a too excessive decline compared to the bond's quality. This offers a very interesting opportunity, investment opportunity. And this can take some time. The recovery can take some months. But when this happens, when the factor behind this price decline is solved, the price moves higher very steeply and rapidly, thus generating pure alpha. And the most important thing about this, which is roughly 20 to 30% of the assets, is that it's fully uncorrelated with the market conditions. What this means is that it doesn't matter whether the government rates go up or down. The price of these bonds won't move. They will only move as long as they solve the problem or the situation or this factor. We therefore believe that the combination of both parties gives us a variety and potential to secure higher returns. Let's now move up one slide. This is how this is transferred into figures. The return upon the maturity of the portfolio is around 12%. But this is the current return. The bond coupon divided by the price of these bonds that they're paying out coupon. So this is 7.4% of return, 7.4% versus 4.6% of the benchmark. So if we keep the portfolio as it is today, and if the bonds are kept to maturity, this is going to secure 7.4% annualized return. I'd like to stress out something else, that is the quality of ratings in our portfolio. At the moment, it is true that we have B plus, which is a little bit low for us. Historically, we have maintained a credit quality of B minus, given the amount of decisions, negative decisions by different CRAs. The average went down to B plus. And we are just seeking opportunities to invest and get to the level where we are more comfortable. Finally, the positive news, the returns affecting our strategy. And if we now, please move up one slide. Historically, these are past returns in our fund since its inception. And if you take a look at the top core chart, the benchmark, the baby blue line is way below the fund's yield. And if you take a look at the chart, I don't know if you can see the figures well. Every single year, we have been above the benchmark, with the exception of 2020, where our yield was below the benchmark, 5.8 versus 7.1 of the benchmark. So this year, we are outperforming the benchmark, and the figures really that we put forward at the end of January, at the moment, we are 2% higher than the benchmark. And on the right chart, you see the black square. This is the annualized return of our fund since inception, 11%, compared to other similar funds. And in most cases, the annualized return is 8%. This is a strategy that we follow. It is a highly proven strategy, and so far the returns have been very attractive. And if you now move up to the very last slide I wanted to share with you, the conclusion. You only have a minute left, Nuria, please. So the next slide, please. The last one, the very last one, please. Yep. This is basically a conclusion of what I've just mentioned. If you take a look at the current situation in the market, if you see that we have very low rates, and this is not what's going to generate return this year. And also EM assets mainly, and corporate bonds of lower credit rating, which are very interesting, that still offer attractive values, that compared to the position in our portfolio where we have short duration and exposure to lower credit rating, and the diversification in the composition of the portfolio. We believe that this is a very attractive moment, thus generating positive returns. And this is it. Thank you very much indeed. That's all I wanted to share with you this afternoon. If you have any questions, I would like to ask them as soon as... Yes, we have several questions. And first of all, we also ask advisors to submit their questions. In this case, Rubén Santín has kindly submitted this question from Mafre Gestión Patrimonial. Rubén. Yes, I had a question for Vontobel Asset Managers. And as the situation improves, the pandemic, the crisis, and we leave this lockdowns in the past, could we see an inflation pick up and abrupt increases of local currencies in view of the massive fiscal and monetary expansive policies we've seen from many central banks? Thank you very much for your question. In principle, please note that my fund is US dollar corporate debt or corporate bonds. We do not have local currency exposure, though inflation can have a direct impact and will clearly have a direct impact on fixed income and EM bonds. And we believe one of the most important risks this year is that inflation may generate an increase in government rates of developed economies. And the problem this may cause, and that can have an impact on fixed income in general, is that over the last few years, where interest rates were even negative, companies financed in the long run, finance itself. So duration of the benchmark has expanded. And this is for us one of the biggest risks that we can see in fixed income in the upcoming years, really. So in our fund, how is this shaped? We have short duration. So we are, to be honest, less exposed to these risks. And we strongly believe this is where we need to be, where there is bigger risk to suffer interest rate hikes. So we believe it is an excellent opportunity to enter corporate debt, but with short duration. We have been asked about the application. Please show your likes if you liked it, really. So would you argue that your fund has higher risk compared to their peer group? comparable funds? No. Because in reality, the most important thing is to understand that what is expected risk and non-expected risk. So if you invest in companies where the price goes down to a very low level and you purchase at the moment, in reality, you have, overcome this risk. So what's there is basically only potential for upside. So no, we beg to disagree. And as long as we invest in the adequate targets and the most valuable companies, so we have a real strong growth potential. We have another question. Given the biggest deviations of the fund compared to the benchmark per sectors and industries?
That's a very good question. We follow the benchmark, we do, but in reality, we're not investing in corporations for the mere fact of them being on the benchmark. What we mean by this is, for example, in China, we have a higher position compared to the benchmark because we believe that there are many corporations that offer a very attractive value, especially when considering construction companies or real estate corporations. Also, in the financial sector, our position is way below what we have in the benchmark. That the reason for that is that we think that the spreads are not very good. In countries such as Singapore or Korea, in reality, we're not investing. What I mean by this is that we follow the benchmark as a reference, but we don't make our decisions, our investments decisions, based on having a company being part of the benchmark or not, but because of the actual money-making opportunities. And the very last one, and I would like to hear a very fast question. In situations in which there is a sell-off in the market, like the one that we saw last year around March or April, how do you do things in the fund? And I ask you to be brief because we're running out of time. We always maintain around 3% cash and liquidity, so we don't have that many opportunities for selling. We have a very good relationship with the brokers. We know where we can buy and sell the bonds, and that's very important to maintain a very, very good relationship with the banks so that we can do the trading at the right time. Wonderful. So thank you very much, Nuria, for your time and for being with us from Zurich. I hope you're good. Thank you. Okay, so now we can go into the voting. You know, you have to get into finet.com/bios. You can get to the web app there where we're going to be launching this survey so that you can assess this investment idea on EM. And the time to vote starts now. You've got the QR with the link to finet.com/bios. We're thankful for your participation in these surveys because this allows us to improve our themes and to choose better guests in future BIOS sessions. Let's see what you thought about Nuria's presentation, and now is the time to vote. This is the countdown for the voting. Thank you very much. We have the QR code, and every time we have a manager talking to us, we give you there the information to those funds, and there you can get to know how to initiate the contracting of those funds with the different partners there. Of course, with EBN Banco, you get a link to EBM Banco, and you can get access to these clean classes of assets. Okay, so if you're ready, we can go into the third idea of this second BIOS session.
Vamos ahora.
So we're now flying to Paris. There we have Matthieu Rolin. This manager invests in corporations that provide security services to fight the risks that we're facing. That happens in the ring of management because in his free time, he also boxes. It is one of his favorite sports, like running or like enjoying a good rugby match. So thank you for being with us, Matthieu. It's very nice having you here, and they're telling me that you're going to be giving us the presentation in Spanish. That's wonderful. So we give you now the floor. Thank you very much, and thank you very much for that wonderful introduction. It was really good. Okay, you have the floor. Well, thank you very much for giving me the time to present to you our fund, Thematic Safety, for managing assets, specializing in thematic management. We are associated to the Eurosift group that has 50% of the capital of our company, and the managers are all managers of a very important Swiss bank, and they are expert in thematic management, and they have more than 10 years of experience on this field in being one of the most important theme managers. Today, we are managing more than 3 billion euros. And I'm going to present to you right now a very important investment fund so that you can understand how we're working and how we differentiate ourselves from our competitors. Our investment philosophy is based in 4 pillars, as you can see in this slide. First of all, the one that it is called secular growth. For each one of the companies in which we grow, it's benefiting from a structural change in the world that we're living. And those changes are going to be the drivers for the growth that we're going to see in the next 5, 10, and even 20 years forward. The changes or the reasons behind these changes are demographics, regulation, and the current situation. Secondly, we're concentrated. That means that we know a lot about a limited number of securities. We do not cover the whole market, but we're only covering 200 and 250 securities that are part of our investment universe. We're concentrated in the financial aspect, but also in the extra-financial field. We're also free from constraints. That means that we don't have a benchmark, we don't have indexes, and we don't have geographical constraints, historical constraints, or market capitalization constraint. Our portfolio, the portfolio of thematic security, is the result of our research, and we're concentrating in 40, 50 companies at the most. And finally, we want to do it responsible management. We are long-term investments. We are fully convinced on being abiding to ESG criteria, and this is part in our investment process. First of all, we exclude the corporations that are related, for example, with the use of weapons. Then we analyze environmental, social, and corporate governance elements. Thirdly, we take into consideration these ESG elements when determining the weight of the positions in our portfolio. And finally, we vote in our shareholders' meetings together with the board of directors with regards to these ESG aspects. And at the end, we are the only fund within the market specialized in security that has been labeled as socially responsible. Let's take a look now at the investment opportunities. I'm going to explain why to invest in this thematic security fund makes sense in a global portfolio. Security represents an extraordinary investment opportunity. I'm totally sure that you all remember your economy courses and the famous Maslow pyramid. This pyramid shows the basic needs of men and its hierarchy. On the basis of that pyramid, we find our physiological needs, such as eating and drinking. And right after, in this second step, or the second step of this pyramid, is security. Security shows that security is an essential human need. We cannot live without security, and that makes that the expense in security is very resilient. In fact, we cannot live without it. Let me give you an example. Let's imagine that we're in an event, in a situation that we're living right now. And in this situation, in the midst of a recession, the revenues of the corporations can drop, and they can drop dramatically. They need to save, they need to cut on their general expenses, they need to cut on headcount or employees. But the last thing that they're going to be cutting, it's security expenses. If they are capable of reducing physical security expenses, and in those cases, I'm talking about surveillance cameras, etc. Anyone can get into the offices, into the headquarters of the corporation, and steal sensitive information. So therefore, they're not going to cut down on those securities, and definitely they're not going to cut down on their cybersecurity expenses, because they could be penalized. And also, not only the fines will they have to pay fines, but their reputation will be affected, and they can be making covers of newspapers. Also, because of the GDPR in Europe, they can be fined of up to 20 million euros, or 4% of their revenues. And I don't know if you remember what happened to British Airways in 2017, but the corporation was hacked between April and September that month, and they were fined for an amount of 200 million euros. That's a lot of money. And this type of regulations protecting the data of the customers and data in general terms is being further developed worldwide. Security is so relevant that it shows a solid and strong level of growth, not only in terms of investment, but it is showing a tremendous increase in the revenues that they are producing, almost fourfolding the long-term growth rate of the world economy. Security is around us all the time. We live, or we try to live, in safer times every day, and we don't realize, but these security elements are part of our day-to-day life. So much is so that we don't pay attention to them anymore, but they're all over the place. That's why in the next slide I'm going to show what I'm saying, and I'm going to verify that security is all over us and at all times. You can see, for example, that at any point in time, during the day or during the night, we're all seeing different elements of security. For example, security in the power network. This security has to be guaranteed. On the contrary, we can create chaos if large cities such as Madrid or Barcelona suffers a total blackout. Also, security in the access of corporations and public buildings. Also, payment in security. For example, with COVID, contactless payments have been broader developed. But this is possible because every year, thousands of billions of money are invested in security. You can see this in this slide. I'm not going to describe everything that we're having here, but I'm going to present to you our investment universe so that you can understand the type of companies that we're investing on. Here it is. This is in the slide. And we've divided into two parts. On one hand, we have the companies that are part of the digital world, and on the other side, we have the companies that belong to the real world. In the digital world, we are investing in connectivity and in e-purchases. In connectivity, we invest in companies that protect our digital space and our data. We're talking about cybersecurity, data centers, and even cyber insurances. With the multiplication of our connected devices, the IT networks are extended towards the infinite, and we need more innovative solutions in order to protect them. In our thematics fund, our work is to identify the corporations that invest in that and to invest in their capital. I'm talking about companies such as Equinix, that it is the world leader in data centers, or Zscaler, which is the inventor of tomorrow's VPN. And in the real world, we invest in, for example, in the digital world, we also invest in the digitalization of the payment with the credit card or with the mobile payments done with the mobile phone or with the smart watches. The COVID-19 crisis has reinforced this trend because of health reasons. Many consumers do not want to touch a coin or a bill. And also the e-commerce is promoting this trend. For example, we are investing in PayPal, which is the worldwide leader in internet payments, or Exis, which is the leader of this type of payments in Italy. Now, in the real world, in this second world in which we are investing, we have, first of all, the sector of food safety, organized around water safety and food safety. We're investing in corporations such as Ecolab, which is the world leader in hygiene, Thermofix, in the healthcare test. Then we have the subsegment of mobility, concentrating in the security of transportation, cars, trucks, train, or subway. In this sector, do not ask me what is the safest car in the market. I have no idea, but what we're interested in is in the digitalization of the security of the cars. In the past, manufacturers tried to limit the consequences of car accidents with the seat belts, airbags, etc. But now, thanks to digital innovation, what they're trying to do is to actually avoid car accidents, not the consequences of the car accidents, but the accidents themselves. I'm going to give you some figures so you can have a more clear idea about what's going on in this sector. Nowadays, in the car, the contents of digital safety is around $300 and $350. In 4 years' time, that amount will exceed the $1,200. That's what I call safe growth, and that's what we find in our portfolio thematic safety with the corporations we're working with. Then we have our day-to-day security, access control to certain buildings, control of beaches, etc. Beach control is a business in constant growth, and the effect of globalization and play control. Play control is what we are controlling because of global warming. With global warming, certain pests are colonizing territories that we not being used. That's why we are investing on the leaders of pest control. And finally, safety, health and safety, labor health and safety. That's the last subsector that we're investing in. And here, regulation is the main drivers of this sector. We cover personal health, the health of the corporation, and the safety around the management of dangerous waste. But you can see we are grouping many investment opportunities here. Some words about the profitability, which is a topic that I'm sure you're interested in. Since the beginning of the year, since the beginning of this year, we've had a positive profitability with an increase of 5%, whereas the global market of securities has gone up by only 4%. And last year, in 2020, and even the year before, the fund already outperformed the securities market with an increase of 38% versus 27% of the securities market in 2020, and an increase of 41% versus 14% of the market in 2020. 2020 was a very good year for our fund because most of the corporations in which we were investing contributed to provide solutions to the COVID-19 crisis. For example, in the digital segment, we've seen the development of remote work, and that has obliged the corporations to reconsider the cybersecurity policies, and they are investing in more sophisticated solutions. Also, the sector of digital payments has been fostered by the fast development of contactless payment. And in the real world, companies that provide PCR tests, labs, are the ones that have broadly contributed to foster the profitability of our portfolio. In 2021, coronavirus will still be with us, even though vaccination has started. That's why we believe that the securities in which we invested in 2020 will continue on providing good results. But also we can benefit from several catalyzers, such as the development of 5G, the economic recovery, and the speed up of digital payments, and the continued renewal of the automobile fleets. And that's why we are well positioned to obtain good results in 2021. So thank you very much, and we're ready to take your questions. Thank you very much, Matthieu. I believe that in order to answer your questions, well, thank you very much for preparing your presentation in Spanish, although I think that you prefer to answer the questions in English. And the first question is formulated by a financial advisor. You know that every time we finish one of these blogs, we have a financial advisor breaking the ice and sending a question. This is formulated by Pedro Valenzuela, one of our advisors in our Finect platform. Hi, Matthieu. Seeing the example that you gave us, well, you gave us several examples of corporations, more specific the one of Valores, and I'm amazed at the EBITDA margin being negative, minus 6.5% for the fiscal year 2020. And I would like to know, on one hand, what are the reasons for that situation, for this negative EBITDA margin? And on the other hand, I would like to know what are the measures that the corporation is going to take to change that situation in their operational processes, and the measures that they're going to take, or they have already taken, that make you feel satisfied enough as to maintain that company as part of your portfolio. Thank you.
I didn't understand the name of the company, I'm afraid.
I think it was
Valores? I think it was Valores.
Okay, got it.
Sí.
I think it's Valores. Valores
sí.
is one of our highest conviction in the portfolio. It's an internal threat detection company. It's based in the US. It's a mid cap, very high growth. EBITDA is still negative just because they're investing like crazy. After the COVID crisis, and after the huge cyber attack that happened, the Sunburst cyber attack that happened a few months ago, they saw many clients going to them just to get their solution. So I'm not very concerned by the fact that EBITDA is still negative, because I know they're investing heavily in sales, particularly, and also in development, because they are developing new products, I would say, every quarter. But why I'm very comfortable with that, the strategy is very clear. They want to sell more and more modules to the client, and they're succeeding. Just to give you an example, 2 or 3 years ago, before they implemented the subscription model, they were selling on average two modules per client. Now they're close to 5 modules per client, and they're reaching new clients every day. So I'm very happy to have that position in the top 10. It will remain in the top 10. And when I look at the growth rate of the company and the valuation, I'm still confident it has upside potential. And keep in mind, competition is very weak. They are almost unique in that type of business. So don't be afraid. We stick with that very good position in the portfolio.
Matthieu, te preguntan también por PayPal.
We're also asking you about PayPal. Do you think that a company like PayPal, in which you are investing, can end up having many competitors in the coming years, given the fast increase in the internet payment solutions?
PayPal is also a company I like a lot. They have the Investor Day last week. That was just tremendous. Many announcements, very bullish, very positive on the stock. I mean, the company has been in the space for, I don't know, probably 20 years now, like very long time. It's the first mover advantage, right? Competition could have been tougher, but they managed to be to have the best growth, and they have the highest penetration rate in the market. It's very difficult to compete with them because they have the best solution, easy to use, and it's going to be even easier when they're going to launch a new application. So I think PayPal is a very long-term position for us, and competition. I mean, everybody's trying to compete with PayPal, but they're way ahead of competition. So from a technology perspective and a penetration perspective, I think PayPal will be ahead of competition for many years to come.
Hay muchas compañías, como decías, que se han...
There are many companies, as you were saying, that have benefited from the lockdown, from the pandemic, that will continue on benefiting for a few months during 2021. But for the long term, we believe that the vaccines will work. Couldn't it happen that they are not so relevant in the next 3-5 years if you're thinking about investing in this type of companies?
Well, we haven't invested in those companies because of the crisis. I mean, we haven't changed the portfolio so much during the crisis. The trends we have identified existed before the COVID-19. I'm just saying for people who are afraid that valuation seems to be high, and when the COVID, when we are all vaccinated, we won't see COVID anymore. That's wrong. COVID will stay with us. I'm just saying the trends we've identified with more like quality food and water quality control will remain in place after the COVID crisis. Just to give you a figure, 30 years ago in the US, to test the quality of water, only 8 elements were tested. Now we're testing 80 elements, 10 times more. That's not related to COVID whatsoever. It's just innovation. It's just reducing the cost of testing so you can test more. And it's better for health and for the people. So that's going to last after the COVID-19.
También preguntan por la parte.
They're also asking about your participation in technological companies. It is true that in your portfolio, you've spoken about technological companies and others that are not so technological. What is the weight of pure technology in your portfolio?
Oh, the weight of pure technology companies portfolio? I would say 25% maybe. Because I mean, most of the Connect companies are technology company, but even the payment space, if you look at the typical classification, Visa is classified as a technology company. I don't think it's a technology company, right? So if I take the actual classification, that should be the GIG classification, as we call it, that should be more than 50%. But in reality, it's less than that because we're more diversified than that. Visa is not a technology company; it's a payment company. Just like Fiserv or Global Payment.
También dicen, ya que existe.
Since there are several funds in this theme, what differentiates your funds from the one of your competitors?
We have a different process. The way we build the portfolio, the way we build the solution. Our competitor, for instance, they look at the purity level of a stock. The more exposure you have to the theme, the higher the weight in the portfolio. You have a more, I would say, investment-friendly approach, which is the higher the upside potential of a company, the higher the weight. I mean, we put a filter, a thematic filter at the beginning. If a company is part of the investable universe, it's because it complies with our thematic criteria. After that, we just focus on financial analysis, valuation, upside potential. That's what matters to us. Also, the fund is smaller. The funds from competition are way bigger. We're going to limit the size of the fund at 3 billion. Competition, the size of competition is twice that. When you run a fund that's, for instance, 6 billion euros or $6 billion, you cannot invest in smaller companies. So you have to shrink your investable universe. That's something we want to avoid. So we prefer to stay smaller, but have the ability to invest in small and mid-cap companies because that's where we found tremendous investment opportunities, because when we invest in smaller companies, we can invest at the early stage of the development of the company and at the early stage of the product development as well. So that's very positive for the shareholders and that's very positive for the investors.
¿En cuánto estáis ahora de patrimonio en el fondo?
What is your current equity in the fund, and how would it be if you made these 3 billion? Would you do a soft closure then?
So we closed the fund at 3 billion, and as of today, it's close to 800 million. So we have room to go. There's still space, of course, But what I'm saying, the limitation is a rule that the founder of the company has put in place on day one. We have a committee that meets twice a year to determine the maximum size of the fund, and it's 3 billion, and it's a hard limit.
Okay. Pues muchísimas gracias, Mati, por tu...
Well, thank you very much for your time, for being with us this afternoon, for answering these questions, and for preparing the presentation in Spanish. That was wonderful. Thank you very much.
Thank you.
Fenomenal. Vamos a pasar a las votaciones. Alguno dirá, son muchas votaciones. Hombre, a nosotros nos gusta, ya saber.
Let's start voting, you know, in a 23rd of February. For what it represents, well, that's a lot of voting, but please rate this investment idea in the security and cybersecurity. Finect.com/bios. As you see on the screen, the QR code, so you can start voting. Finect.com/bios, so you can give us a feedback about your thoughts on these presentations. Let's now move on to the second question. How did they present? How did he expose this idea? Time to vote starts now. Okay, what do you think of Matthieu's idea? So that was a presentation, how he answered the questions that we asked him. Thank you very much for your time. Only 2 interesting topics are left. Let's now dive into the 4th topic for this session.
Vamos ahora a...
Let's fly to London, where we have our next connection with Ben Ritchie, who is a fixed income asset manager who's been investing thanks to his grandpa. The last 19 years, he's working for Aberdeen. Running is one of his greatest passions, what helps him relax and come up with new ideas. And he also enjoys cooking, one of his greatest passions. The time is yours, Ben. Welcome back, Ben. It is a pleasure to have you on board. Thank you.
Thanks for having me. It's much appreciated. The opportunity, I think, in Europe is not as exciting as cybersecurity. It's not as exciting as many of the other thematic stories. And for many of you who've been thinking about or have been invested in Europe over the years, it will be in a market that will have been somewhat disappointing. Many promises, not much delivered over many years. But what I want to talk about today is why we're a lot more optimistic about the long-term prospects for Europe, both today and in the future, and why there are some structural changes in the marketplace, as well as the opportunities at the company level, which should make you a lot more enthused about the prospects within the European marketplace. And I think it's important to say that it's a market which offers the opportunity for balance. It's not just about technology, it's not just about biotech, it's not just about pharma or banks or industrials. It's about having a well-balanced market that offers you a range of opportunities which are all potentially quite attractive. So when I turn to the first page, just to give you some thoughts about why ASI is a company that you should consider to manage your money in this marketplace. Importantly, we have the resources, the research base, the ESG integration to tackle what is a broad, complex and deep market. And we think that at the heart of it all, research is going to be the key thing for alpha generation and the delivery of outperformance over the long term. And we're really well resourced to be able to deliver that. That allows us to do a number of different things, some high active income and within the responsible investing space. And we think that's really important because at the end of the day, Europe is a complex market. market. It demands active management. It requires you to be differentiated from the benchmark. It presents many different opportunities in many different fields, whether that's idiosyncratic, income, quality investing, but it does require the work on the bottom up to be able to find those ideas. And we think that there are some really interesting structural opportunities for Europe over the next decade, whether it's leadership in responsible capitalism, whether it's leveraging many decades, centuries in certain cases, of the intellectual property which we have within the continent, or whether it's the coming development of industrial technology. And I think that's a really interesting area where Europe is going to catch up with the United States, where its industrial heritage starts to drive our performance within both industry and the technology area. So if we look at this chart, we can see that Europe has been a fundamentally disappointing place to invest. Why is that over the last decade? Well, it's very simple. Earnings have been poor. There's no magic as to why Europe has underperformed. It's underperformed because its earnings have underperformed the delivery of the MSCI world. And if you consider this against the United States, for example, then it looks, as you know, much worse. And that's because over the decade, we've generated earnings growth of not much more than 2% per annum. So that's the market backdrop. Why was that? Well, on the left-hand side, it's not so much that Europe was over-indexed to underperforming sectors, although it was. We had more money in sectors which performed badly, but we were also massively underweight sectors which performed very well. So we were overweight things like telcos and banks, underweight areas such as technology, which perform very strongly. And both of those things have hindered the performance of Europe over the last decade. But as we look forward from here, I think there are some reasons for optimism. Those drags on market performance over the last decade are going to be perhaps smaller going forward. Now, it might be that we see over the next 12 to 24 months better performance, perhaps from banks or telcos. But over the longer term, having more exposure to better returning, higher margin, faster growth businesses will ultimately deliver better returns for the market. And I think when we look at the overall picture here over the last decade, we can see bigger exposure for Europe in things like healthcare. And in some of those sectors that have been a real drag, we've got a lot less of weighting to them. And I think that's going to be important as we look out over the next decade. And I think when we look forward from here, again, Europe has much more exposure to segments which are actually quite high returning, lower fade return segments. So again, in terms of pharmaceuticals, food and beverages, luxury goods, even utilities, which we think is a segment that could look increasingly interesting over the next decade, or within the diversified financial space, Europe's positioning in those areas has increased, and it has relative overweight to those areas which we think are more interesting and represent well over half of the market today. And we think overall that gives quite a good balance in terms of return drivers for the market. It's not just about one thing. Of course, Europe continues to lag in terms of its technology exposure, both against the United States and the rest of the world. And while, again, in the near term, we may see some reversal of that, I suspect that that is likely to be a headwind for the market over the longer term. But it's not such a big gap that as an active manager that you can't decide to bridge that through your own stock selection. So about 13% underweight relative to the global market. But if you want to bridge that gap with your individual stock picks, you're more than able to do that within the marketplace. Importantly, one of the real drags, I think, for Europe over the last decade has been our exposure to international growth. We are primarily driven by global growth. We have big exposure to China, to emerging markets. And over the 2010s, that was not a great place to be. But over the decade 2000 to 2010, that was a good place to be. And when you can see here more than half of the revenues for most European markets coming from outside of Europe, if you look at something like the UK, it's only 25% of revenues are coming domestically, then actually our reliance on a faster growing global economy is really important. And if we think that we might be in a world where we're about to see better performance from emerging markets, then Europe is well positioned to take advantage of that going forward from here. The other area that, again, I think plays in Europe's favour is its leadership in ESG. And you can see here that European companies consistently get higher ESG scores than those in other markets. We think that's going to be very important in terms of driving capital flows into the market, reducing the cost of capital, driving up the multiple for European companies. But it's not just about flows of money. It's also that these types of businesses have performed better. And if you look on the left-hand side, you can see that these businesses have generated superior ROEs. They've generated less volatile earnings in the middle chart. And they've also started to generate outperformance versus the benchmark. And so not only do we earn a situation where our companies get better ratings, but they also perform better as well. And that's absolutely critical, and we think will be a good advantage for Europe over the longer term. And again, I think it's very important when we think about the buy case for Europe, it's very often that it's cheaper than the rest of the world. It's very often that PMIs are improving, that the delta is picking up, that there's something going on politically or macroeconomically. But I haven't found those to be particularly satisfying or sustainable drivers for outperformance from Europe over the long term. Much more, I think, is to look at the type of businesses which are available to you to pick as a stock picker, the key drivers that sit behind them, and look at those companies and think, actually, those are going to do phenomenally well over the next decade. Those are great things to have in my portfolio. And those are things which really get us excited. And that's really the key driver. So we don't own all of these companies within our specific portfolio, but we own them across different funds within the team. And I've put them in there to give you a flavor of the kind of opportunities which sit within the business. Whether it's reliance on that heritage of intellectual property, great brands like Ferrari or Hermes, technology IP within the healthcare space, such as Lonza or Essilor, Luxottica, or indeed in some of Europe's emerging platform operations like Schibsted, or within the computer game space like Ubisoft, that intellectual capital is a great starting point. In terms of responsible capitalism, Europe is really well placed to ride the opportunities that are going to come out of the need to decarbonize and improve the environment over the next decade, whether that's about enzyme manufacturing with the likes of DSM or Novozymes, whether it's about biofuels in the form of Neste or wind power in the form of Ørsted. Europe is well positioned. And when we look to the digitization of industry, that's an area where I really think that Europe's going to catch up over the next decade, having been behind on those big consumer platforms like Facebook, etc., which we didn't have. Given our industrial heritage, we're much better positioned when it comes to the industrial revolution on an industrial basis, which we face today. And just to give some examples of that, these are, ASML is a company you all know, but the machines that it makes literally drive the modern technology world, and it effectively has a monopoly in the manufacture of those. It is a phenomenal company based in Veldhoven in Holland. It is a true European champion. It is a global leader, and it's very well positioned for the very, very long term. And not only is it a great business, but it's also a business that's getting better as well. Something like Heineken at the other end of the spectrum, a business that suffered from the impact of COVID, but a great brand, a brand that's grown high single digits over many, many years, great exposure to emerging markets, which are tough today, but which we think long-term will be quite attractive, and a great example of a European brand, European intellectual capital that will allow it to grow again over the longer term. Very much a yin and yang of stock selection today. And when we think about the type of strategy you might need to take advantage of these opportunities within a European context, well, this is how we go about doing it at Aberdeen Standard. A real stock-picking fund focused on the best ideas, really all about bottom-up stock selection. We buy across the market cap spectrum. It's an all-cap strategy from 3 billion to 250 billion, based all on our fundamental research, high conviction, just 30 stocks in the portfolio, very much a focus on implied returns, which drives valuation discipline, and thinking like real owners of a business, not just from a governance perspective, but also from a strategy perspective. And that drives a high active share, high tracking error product with low turnover, good upside capture, downside resilience, and good risk-adjusted returns over the longer term. And when we think about ESG, that's something that's absolutely embedded into every step of our process, from idea generation through to portfolio construction, and then ultimately into engagement with companies as we become investors in them. And that's really critical, because while this is not an SRI fund, nor does it have explicit exclusions, through the focus on higher quality businesses, of which ESG is a key selection criteria, it allows us to filter out many of the very challenged businesses within the market. And again, that's really important, not just from a risk management perspective, but from also an opportunities selection as well. And why is all of that important? Well, if you can find the right companies, and if you go back to that chart I showed right at the beginning that said that Europe had grown its earnings at less than 2% a year over the previous decade, if you can find the right kind of companies, then actually they've been able to grow their earnings at nearly 10% a year over the last decade. These are the companies which we have in our portfolio today, looking back at their performance over the last 10 years or so. In fact, actually, this chart going back to 2002, so even longer, and have driven their cash flow growth in the high single digits. So if you've been able to find the right businesses, been selected, then actually you've been able to drive some really strong earnings and ultimately share price performance from those businesses. And the performance of the portfolio overall, a testament, I think, to that over the longer term, over the last 5 or 6 years. And so just to conclude, the portfolio has delivered good returns in what was a tough year in 2020 through a range of different conditions. It's a really active product, very much focused on the long term, trying to find those really good businesses which we think can prosper. Again, ESG, absolutely the heart of what we're doing, and all about leveraging our research base to be able to drive the best ideas and then implement those in the portfolio and putting the most amount of capital we can do into our best risk-adjusted ideas. And that focus on investing in good quality companies helps to limit our downside risk as well and generate good upside capture, good downside protection, and decent risk-adjusted returns. And while Europe faces its challenges, we really think it's an attractive market for stock pickers over the long term, particularly with those with the resources and capabilities to be able to find those really interesting ideas. So thank you very much for listening. It's great to be here and have the opportunity to talk to you about European equities.
Thank you very much, Ben. To break the ice, we just have a couple of questions because the audience doesn't want to ask them. But financial advisor wanted to ask you, Antonio Garay from Caser. Hello, my name is Antonio Garay from Caser Financial Advisors. Do you have any specific bias of companies where you're more likely to invest?
Well, we don't really. I mean, we look for companies that have a certain types of characteristics. So we're looking for businesses that we understand, businesses which we think have strong, long-term, sustainable growth prospects. We're not looking necessarily for super high growth companies, but we are looking for sustainable growth. We're looking for companies with strong balance sheets, great management, really good management of their ESG risks, and companies that operate in industries which we think we can generate attractive returns from. And if we can find businesses that meet those criteria, then we'll invest regardless of the industry that they come from. So that tends to lead us into certain sectors. So we do have more of a weighting in things like healthcare, consumer goods, technology, but we do find investments within the industrial space. We do have a decent exposure to consumer services. We have an overweight position in financials. So we do have a range of companies from across different segments, but our process does tend to take us towards the higher returning parts of the market.
Ben, tenemos aquí una...
We have just received a question through finect.com/bios. Thank you for asking all these wonderful questions, our lovely audience. Thank you. So the question for Ben is, do you believe there will be a momentum among EU corps, the most industrial ones? And what percentage of the most industrial companies do you have in your portfolio?
Stocks are well positioned to take advantage of the recovery which we're going to see in 2021 and which will probably continue into 2022. We've got around sort of the high teens, close to 20% exposed to industrials within our portfolio today, and primarily that's companies investing in areas like compressors, some also servicing the semiconductor space as well. But a variety of different end markets. And we think that the prospects there are pretty good looking forward from here. I think that said, a number of these companies have performed very well already and are pricing in a good degree of that future recovery. But we're, I think, quite optimistic about the prospects for the general outlook for European industrials from here.
Nos preguntan...
What is the geographical footprint of your fund? Where do you invest? Where are you overweighted?
Well, we tend to be very stock focused, so the geographic output tends to be sort of function of stock selection. But our biggest country overweight is to the Netherlands, and that's really driven by the fact that we happen to find some really good companies there, like ASML and Heineken, I guess, are both Dutch listed, but they are very international in their exposure. We're sort of fairly neutral in terms of our exposure to the UK, and we have a bit of an underweight to Switzerland. But that's really just a question of not having found as many companies there as the benchmark, I guess, overall. In terms of our sort of revenue sort of look-through picture, we are overweight dollars versus euros by about 10 percentage points. And I think that generally reflects more of a tilt to international businesses that are more global in nature rather than more domestic-facing businesses.
Yesterday on the credit sessions, another participant said, we still find interesting opportunities among banks and financial institutions. So what about Draghi's arrival in Italy? What is your view on this? Do you think this is positive, that the arrival of Draghi to Italy, a former ECB chairman, the arrival to Italy, is it going to be good for financials?
I think Draghi's arrival will, I think, help in terms of managing the perception of Italy. I think it helped in terms of continuing to drive reforms there, and I think in terms of building a more stable government. But I guess we'll have to see. Many people have tried to aid the stability of that sort of political structure, and it hasn't always been the case. But one of the things that I always like about Italy is that companies are used to dealing with changes of government, with volatility at the political level. They just get on with it and they manage it, and they're used to working within that situation. So I think it's helpful, but I don't think it's the be-all and end-all. I think when it comes to banks, the prospects today clearly look a bit better than they did 12 months ago. The outlook for credit losses looks better. Interest rates have sort of the prospects of them falling further has probably reduced, and there's probably more appetite for loans. And we do find potential within financials, not particularly within the banking sector, but we do have quite a bit of insurance. We've got exposure as well to specialist asset managers. And then also to stock exchanges as well within the portfolio. So, as I say, we have a modest overweight, I think, overall to financials, and that's a sort of a mix of different types of companies. We do look at a number of banking institutions. We don't necessarily have any in the portfolio at the moment, but we are looking. It's finding the companies which we really want to invest in for the long term. I think that's the challenge with that one.
Aunque es un evento internacional.
This is an international event, but for a European fixed income manager, the question is, what is your view on the Spanish corporates? What's your exposure in your portfolio?
Yeah, I mean, our biggest exposure to Spain comes through Amadeus. Again, I think that's a fairly typical European company which doesn't have a huge amount of dependency on its domestic market, very global in terms of its approach, has clearly been hit very hard by COVID, but we're long-term investors in the business, and we're happy to see it recover. And we think that longer term, Amadeus will come out of this as a stronger, more robust company. It's continued investing in its technology through this period. Its competitors are highly leveraged. They're likely to perhaps see their competitive positioning slip back over this time period. So longer term, I think we're sort of quite optimistic about the way in which Amadeus navigates the recovery out of this crisis. And then there are other businesses within Spain which we don't own in this portfolio today, but which we look at and which we respect. Companies like Grifols, Inditex as well. These are very strong companies, and which we're always looking at the potential opportunities that might come out of it. Again, within the renewable space, something like Iberdrola as well, which has been is an interesting company continuing to develop itself. And I guess something like Siemens Gamesa as well. That's sort of half Spanish, half German business, but again a company that is on a journey to turning itself into more of a renewables leader. So there are always interesting opportunities in countries, and I think it's one of the lessons, a bit as I was saying earlier with sectors. it's very easy to put labels on countries, but actually you've really got to look at the companies within them and really look at their prospects. And then actually I think most countries in Europe have interesting businesses within them.
Me dicen desde el equipo que de vez en cuando.
The audience asked us about the ISIN codes, the ISIN numbers for the funds. Please remember that they are displayed on the streaming with a QR code, and you have them on the screen. If you take a picture with your iPhone, you can directly link to the funds fact sheet with the ISIN codes, how to contract this. This is part of our EBN platform for clean classes, and you have all the existing information, which, by the way, Ben, we all have the feeling of the very bad performance of Europe in the past few years. However, in Aberdeen, it's an annualized return of 13% in 3 years. Wow. Is it the feeling much worse about Europe compared to the actual evolution of Europe?
I think, again, at the company level are interesting. And I think, so much of the focus tends to be on the macroeconomics. And I think that the individual company economics can be quite different. If you look at what's driven the US market, it's really been a relatively small cohort of companies which have performed extraordinarily well. And Europe hasn't had those massive platform businesses with the really compelling economics. But actually within Europe, there are plenty of companies which have delivered great results over the last decade. And I think the key is about finding those. And we don't worry too much about what's going on with the wider market. We really focus in on where we think we can get the best long-term risk-adjusted returns. And in that way, we still think Europe has plenty of opportunities. And I think in a funny way, the environment for us as investors, probably a recovery environment, is not so helpful because actually it's a rising tide lifts all boats. But actually, if it gets people more comfortable with investing in Europe and less focused on the macroeconomics and the politics, then that's very much, I think, a positive for us overall.
Pues con eso nos quedamos. Ben.
Thank you very much indeed. We'll keep on monitoring such evolution of your portfolio, obviously, and the latest announcement. Thank you very much for being with us today. Thank you.
Muy bien, vamos a pasar a votar a ver qué os han parecido. Recordad.
Let's proceed with the voting. Finect.com/bios. First voting, what do you think about the investment idea? European fixed income by Ben Ritchie. Finect.com/bios. Okay? You've been here all day, so you probably know this by heart. Finect.com/bios. Now, what did you think of this? And his presentation. Time to vote starts now. Finect.com/bios. For those who like voting so much, just go ahead. You have very little time left. And now the very last idea we have brought along today. Last but not least, we're going to get to know this idea today.
Nordea Asset Management is one of the fastest growing asset managers in Europe, tracing its origins to the early 19th century. With over $245 billion in assets under management from institutional, wholesale, and retail clients in 20 countries across the globe. We serve many of the most prominent global wealth managers and more than 500 distributors. It's all about providing better service, better products, and better investment returns.
Y terminamos esta.
And we're going to finish this third version of BIOS from Copenhagen, where we are going to be connected with Thomas Sørensen. He's fully convinced of the relevance of investments in order to build a more fair society. He likes to see the positive impact generated on the companies that are part of their portfolio, and he also likes traveling to get to know different cultures. We know he will probably like Spain, so we're hoping to see him around here when the pandemic is over. So welcome, Thomas. While we wait for you to come here, we give you now the floor.
Thank you very much. Hola, hola out there. Are you able to hear me?
Yes.
That's perfect. Then I'll kick it off. I'm going to present our new strategy for you called Global Social Empowerment. We have 3 goals with this strategy. Goal number 1 is that we want to create attractive returns. We want to beat the general market over time. The goal number 2 is that we want to move the world in the right direction. That's why we allocate capital to social solution providers for real positive impact out there. Goal number 3 is that we want to be an active owner. So we want to push the ESG agendas inside the companies we invest in. That is the 3 goals that we want to pursue here. Now I'll take you through the highlights. We have a world, or we cannot have a world for only the few. We need to create one for the many. The UN has created these 17 goals to bring the world forward in a more sustainable way. If you look at these goals, the majority is actually linked to social aspects. There's a huge amount of money is needed to reach these goals by 2030. And that is, of course, the opportunity set for companies with solutions here. So a big gap is needed to be filled here. The good thing is that the solutions, they are out there. They just need to be deployed at scale. We have seen a lot of interest in moving the environmental side forward in recent years that we have also experienced at Nordea, but we cannot forget the social aspects. We need to focus now our attention on the social aspects, not forgetting the environmental side, of course, but we need to focus our attention to the social aspects. The pandemic has magnified the issues out there. We need a more efficient healthcare system, education kind of system. We need to find new ways of creating jobs out there. We are seeing big movements like Black Lives Matter, Me Too. The young generation is calling for change. We are also seeing corporates are waking up now. Unilever actually recently announced that they want to commit 2 billion of their procurement budget to bring the S forward. Unilever is not doing it for fun. They are realizing that purpose and profit can go hand in hand. And so increasingly, the new consumers out there, they not only want to know what the products are made of, but also how they are made. This is what we are targeting here. Here you see how we want to address this, how we want to capture the opportunity set. We have defined 3 overall themes: vital needs, inclusion, and empowerment, and then a range of underlying strategies. Then I want to take you through a couple of examples. The first one is a US company called Progeny, and they are engaged in infertility, which is a big issue in our parts of the world, in the Western world. 1 out of 8 couples cannot get the kids they want. Huge issue. The company here called Progeny has created this network of clinics and a platform with increased success rate at a lower cost. So good for the individual couples, good for society. That is an example of a company that we like and have in the portfolio. The Norwegian company Kahoot is engaged in education, and they have created this engaging and fun platform that can enhance that learning experience. It's almost like YouTube of education, an ecosystem of its own. They have a huge, user base out there that they are now actually monetizing at a fine clip. So they have created this tool that is liked by the teachers, by the students, and is good for society. The last example I have here is from Indonesia. That's a company called Bank Rakyat. They are engaged in microfinance. They're the leader there. And if you look at Indonesia, it's a poor country. Almost half of the population don't even have access to a bank account. So more or less shut out of the formal system. Bank Rakyat has the solution, microfinance, helping small individuals like a mom in the family to set up her own business, and that so she can earn money to bring her kids to school. And you can already see all the positive ripple effects. It's of course important that we look at how much they earn on these micro loans, so they don't indebt the people that take these loans. They are now helping 10 million, here a number from 2019. So positive impact out there in the real world, and good for us as shareholders. The strategy is managed in the fundamental equities team, and we are based in Copenhagen and Stockholm. What goes across everything we do in fundamental equities is sustainability. This is also here where we manage our climate environment strategy, and it's here that we manage the ESG stars range that you know from Nordea. We use the same investment process as we have used now in the climate environment strategy for over a decade. Obviously, with a different starting point, a different universe. But the following steps in our repeatable investment process, these are the same. So the starting point, the universe, then we do a fundamental and ESG analysis, then portfolio construction and risk management, and then active ownership. And there's a nice feedback loop from the active ownership into the fundamental and ESG analysis. I'll take you through some of the steps in more details here. So when we look at a company, then it's important to stress that we believe that no one company can sustain its competitive edge forever. So returns will come down over time. That's also what we can observe out there. But we can also observe that some companies are just better than others. That is what we want to find out here. So we look at these aspects that you see here. The strategic assessment, so looking at the exposure to the theme, business fundamentals, financial performance, corporate culture. We look at all aspects of ESG, and we look at the alignment to the SDGs. We want to capture everything here, finding out how strong is the company, because we want to tie this into how we value the stock. Good company, not always a good stock. And this is how we do it. We do a kind of DCF, a long-term DCF. So here I show the return on invested capital over WACC. So a kind of forecast period of 10 years. But what after year 10? Yeah, then to incorporate that no one company can sustain its competitive edge forever, we take out 1/3 as a minimum. Then the less good you are, the less strong moat you have around you, the more we fade returns over time. So this is how we link the strategic and ESG assessment with how we value the stock. It's very important to have a disciplined framework here. You cannot invest blindly in a theme or a sub-theme. You need to look at the individual risk-reward. It's also important to have a robust framework when it comes to portfolio construction. What we do is all bottom-up driven. We don't have a benchmark in the classical sense. How we do it is shown in the chart here. These are the elements in our portfolio construction process. First, we look at the Sharpe ratio, a measure of risk reward on the individual stock. The reward we get from our DCF work and the risk we take from the volatility in the market and what's implied in the option market in terms of volatility. We want our job, your job, is to enhance the kind of risk reward. And so intuitively, you should say that we should invest more in companies that expel high Sharpe ratios. That's also correct, but at some point, the weight in these companies will be too high. We need to control that by looking at stock contribution to total risk. This is a limiting factor for us. And that we do because we want to create a product for you with diverse set of alpha sources. That is just so essential. Then to avoid unintentional biases, we also look at total portfolio risk, and that's also a limiting factor for us. Unintentional biases likely to materialize in the total vol, so that we look at and that we limit. And as I said, we have applied this framework in our climate environment strategy now for over a decade, so we know how to use it. This is how the portfolio actually looks today. It's well diverse. We have more currently in the empowerment theme, but that can change over time depending on the risk reward, as I said, on the individual names, and also nice exposure to kind of many of the themes that and strategies that I showed in the beginning. So please come with me on this journey. We should not underestimate the power of capital allocation. We have seen that on the climate and environment side. And this social side of things reminds me about the climate environment 5 years ago. We were starting to see there, company pledging net zero emissions by year X and Y. And we are starting to see the same here on the social side. We have created the vehicle for you. I know it's a matter of trust, but I mean, we will do anything in our powers to get that trust of yours. Thank you very much.
Thank you so much, Thomas, for your presentation, for bringing us here these investment ideas with which we're going to be closing the third edition of the Best Investment Opportunity Summit. In this second day, it has been a pleasure to have you here, and we're going to start with the questions. The first one is being formulated by a financial advisor. We're going to show you the video with the question. In this case, is Miguel Ángel Cicuended asking from Consulae EAF, who is also a partner of ASEAFI, one of our sponsors. So let's show you the video now. Nordea Global Impact Fund, what is the double impact that it has in terms of advantages for the investor and advantages for society? I see that the exposure of their portfolio is very much diversified in the ESG pillars. In environment, you're having 14%, in corporate governance around 36%, and in the social part, you have 42%. And 6% is not allocated. I would like to ask you, what pillar do you think will see a greatest growth, and what will be the trend of your fund with regards to pillar allocation, and how long do you need to achieve your objectives?
We are targeting social aspects here, what I said in the beginning. This is our mission. We want to move the world forward by allocating capital to social solution providers. I gave you a couple of examples in the presentation here. As I said, more efficient healthcare, more efficient education, and ways of working and creating jobs out there. We need to create a world that's more inclusive, and we believe that can go hand in hand with creating attractive returns. When we look bottom up at the companies we invest in, we are seeing this. We are seeing that adoption of these solutions are increasing because it makes sense for all the players in the value chain here. So good for society. It's good for the end user. Hence, that's why we see increasing adoption, and we can benefit, as investors by allocating money to these solution providers.
Thomas, hay varias preguntas.
Thomas, there are several questions as to why now? Why do you think that up until now we were focusing on other things within the ESG that were more taken care of, especially climate, whereas social ones were not being so taken care of, where the UN developmental goals concentrate on society? Why has this happened? Why now?
No, I think the pandemic has magnified the issues that have been apparent for years. But sometimes it all just needs to fall together. So it's clearly that the pandemic has magnified the issues, and we are seeing it out there. If we are seeing it out there with all the big movements. And this is just coming together, everything. So Black Lives Matter, Me Too, and also the young generation, they care about social issues. And that's also why we see corporates now acting. And that's exactly what we saw, these 5 years ago with the climate and environment. We are seeing a repeat of this, and let's allocate capital towards these solution providers so we can achieve the overall kind of reaching goal here, that we want to move the world in the right direction. And we can do that while generating attractive returns. We have proven that on the climate. We will prove it here as well. But it is probably the pandemic that has magnified this. But the issues, they are not new. They have been apparent out there for years and years, that we know. We can just look around in the world. Inequality is just on the rise everywhere, also in developed world. Even in the US, we have 50 million people on food stamps. That's the richest country in the world. There are issues, and they have been there, for years and years, and it's not getting better. I think we are coming to a point now where the world is kind of realizing that if we don't do anything now, it will just end in tears. And the good thing, because the solutions are there, we just need to get them deployed at scale. And we have created, the vehicle for you to pursue this.
Ahí tenéis la dirección, finect.com/bios.
Here you have the URL address, finect.com/bios, where you can formulate the last questions. We only have 5 minutes to close this BIOS edition, but this is a question that we just got. Do we have to get ready for a boom of social funds, the same way that we saw a boom of sustainable products in the past years? And how can we really differentiate the ones that are really social?
We will make this vehicle an Article 9 product according to the EU taxonomy. So that's at least a starting point. But we will also create for you, kind of impact assessments and reports to show you what good the companies are doing that we invest in. And we know the importance of this, that it's not only about creating attractive returns, though I think this is the mission to operate, but we also need to show our investors that the companies they invest in by our vehicle also doing something good for bringing the world forward. We know, and this is also something that we will do, that we will produce.
Hay varias preguntas, Thomas,
There are several questions, Thomas, related with the differentiation.
Precisamente hay una que dice...
Yeah, there is one question that says there are many ESG funds. Why yours instead of others?
to something exciting and new here. You also asked me in the first question here, or the last question, about are we going to see a whole string of social funds out there? I believe we will, because I believe that others will catch on to our ideas here, because this will be an attractive investment opportunity, and that will attract others to the field. But here again, it's important that we have a proven framework. We have proven that on the climate. We were early on the climate, and now we're seeing a lot of Me Too out there. But we have the framework. We know how to manage a thematic product like this. We have done it for decades. So we believe we have a good value proposition. But I believe, yes, we will probably see more funds actually focused on the social. And that's because it will be an attractive investment opportunity. So we can't blame people.
Mm-hmm. Thomas, hablabas antes de
Thomas, you were talking before about inequalities growing in countries like the United States, but also in emerging countries that are still many social things to improve and many social imbalances. What is your exposure to emerging markets in your portfolio?
I think we have around 15% in emerging markets, perhaps a little bit more. Around 15. Mm-hmm. But it's also important to stress that the companies that we invest in, many of these, they are global. They have global reach, so they will also capture the opportunity set in emerging market. So it's not only about direct exposure; it's also about what kind of markets and areas they are targeting. And for the vast majority, these are global companies.
Hay una pregunta que dice, ¿qué rentabilidades se pueden esperar?
There is a question that says, what kind of profitabilities can we expect if we invest in the social pillar? And I would like to add to this question, what are the valuations of these companies focusing in the social pillar versus the ones that are more focusing in sustainability?
Yeah, it of course varies from company to company. We also have, lower growing, more stable compartments in the social empowerment kind of fund that I present here today, and we have more higher growth actually compartments. And this is also the beauty here, that the universe is broad enough for us not to be caught in a corner. This has been also the prerequisite for us here, that it needs to be broad enough for us not to be caught. And that's also why you see our definition of social empowerment, that is, encompassing. Many, of actually underlying strategies, and this is for us not to be caught in a corner. So to your question, we have lower valued compartments and stocks, but we also have companies with high growth rates and obviously then also more expensive. Mm-hmm. But important is that we are doing a thorough work when it comes to analyzing the companies and valuing the stock. I work with the assumption that a good company is not always a good stock. So valuation matters.
Mm-hmm. Mira, esta pregunta me parece interesante. Dice, ¿en qué suelen?
Question is interesting. In what areas do the companies do not comply more? What are the failures of the companies that they do not abide by your ESG standards?
That could be a variety of things. It could be on the governance side. It could also be that they are not on top of environmental issues, and if they don't treat their employers or kind of other aspects of the social pillar in a good and adequate way, then they can also fail on these points. So it's on all pillars, both E, S, and G.
Mm-hmm. Y casi la última, salvo que entre.
The final question to wrap up. in the Sustainable Development Goals of the UN, they spoke about a series of investments in order to meet these goals. How are those investments coming along for the social part? Is there a great deficit of investment, or are the governments investing what's enough? Because I'm sure that this will lead to certain flows of cash for these companies.
No, we are not spending enough. It's not adequate. We are approximately spending half the needed amount to reach these goals, approximately. So this is the opportunity set. We will see more capital flowing into these areas. We saw Unilever as a good example, a couple of weeks ago. It's only a couple of weeks ago, now pledging, as I said, 2 billion of their procurement program to enhance the S. And as I said, it's very, they're not doing it for fun. Purpose, profit can go hand in hand. They know they need to cater to the consumers of tomorrow. And the consumers of tomorrow, as I said, do not only care about how or only care about what the products are made of, but also how. They need to be, it needs to be made in an environmentally friendly way, but also, they need to be, made in a socially acceptable way. This trend is unstoppable, and this is also making this area a very attractive investment. Yes.
Bueno, pues
Well, thank you very much. There are no further questions, and we've come to the end of our time, Thomas. So we're very thankful for your presentation. Thank you very much for getting connected with us from Copenhagen. I hope that you're doing fine there.
We are doing fine.
Esperamos verte pronto por España.
We hope to see you soon here in Spain. Thank you, Thomas.
Vamos a hacer esta última.
Well, this is the final vote. I hope that you enjoy this. We prepared this survey, and it will be interesting to see if your opinions have changed. But the question is, what do you think about this investment opportunity, investing in the securities, but concentrating in the social part of the ESG pillar? Time to vote starts now. There we go. You got 10 seconds. If you really love it, 5-star review. A little bit less 4, a little bit less 3. No less than 1 star, please. Thanks for this voting. Next, go to the second vote. What do you think about Thomas Sørensen's presentation from Nordea? Countdown to vote starts now. You're voting Thomas Sørensen's presentation. You have all the information about all the funds at finect.com/bios, and the advisors need to get the test to be able to respond to questions to obtain your certification for the case of CFA Society Spain and FPA. You have the test that you need to do. We love to get to know your opinion. We're asking you more than if you were in court. And this final question is, what do you think about this last edition of BIOS? Countdown to vote starts now. You've got 5 options. It was very useful for your investment strategy. Second option, it was interesting. The other one's somewhat I like it, or not useful, or too much, or I don't know. You have there the options. Thank you very much for voting. And you have the possibility of entering comments. There was a comment that says it was very interesting. That encourages us very, very much. And of course, you can also comment on the things to improve. If you think that there's room for improvement, let us know. You can enter your open comments, and we would love to see your interaction. So we're going to finish by thanking the audience who were with us today and our partners partners on this event, of course. You know that at the end of the day, they are the ones that make possible for us to do these live events, taking this event to your home so that you get to know the first-hand opinion of all these investors. Aberdeen, Standard Experiment, BNI, Mellon Investment Managers, BMO, Capital Group, Carmignac, Fidelity International, Natixis, Nordea, Schroeder's, Vontobel, and of course, thank you very much to our sponsors, EBN Banco. You know that at Finect, more and more you have more options to hire and to contract investment funds. You know that the information about these funds are at finect.com, and you can contract it at EBN Bank and the professional associations that allowed financial advisors to be recertified. CFA Spain, FPA Spain, and ASEAFI. Thank you very much to all the technical team that have been around here preparing this third edition of BIOS, the Best of Investment Opportunity Summit. All the technicians, all the team from Finect who have been working like mad to bring you the best possible information here, and those who have facilitated this live broadcast. Thank you very much, but we don't want to finish without some announcements. We love announcements, and we announce the future edition, the fourth edition of the Best Investment Opportunity Summit. It will take place in June. Write it down in your agenda. It will be on the 7th and the 8th of June. 7th and 8th of June. That day you're busy. You have to be attentive to your screen to see the fourth edition of BIOS. Thank you very much, everybody.